Privyet, ladies and gentlemen. Allow me say my sincere thanks to the host, Moscow Metropolitan Governor Yuri Luskov University, Moscow, Russia, that invite me to share the presentation today about integrating ESG within portfolios to manage risk and generate return. What is ESG? As a snapshot, when we talk about ESG integration, we need then to understand SDG, ESG, GRCS, and thereafter ESG integration. Let's have a look on the slide. Driven by SDG or Sustainable Development Goals, organizations around the world and across industries are pursuing the credential of implementing ESG or environmental, social, and governance. SDGs are global set out by the United Nations as we know, whereas ESG is a rating system used by companies to measure the environmental, social, and governance credential. I wrote an article in CRMS Indonesia about this. The goal of organizations to implement ESG is to be an organization of integrity to ensure that the values, ethics, statements, commitment, relationship, and transaction are a reality in practice. Whilst ESG is a rating system used by companies to measure their environmental, social, and governance credential, whereas GRCS or governance, risk management, compliance, and sustainability is a set of capabilities to bring about such credentials into reality as the base of measurement and reporting. Now, about ESG integration. ESG integration consists of three levels: level of research, level of security, and level of portfolio, which has four domains: risk management domains, portfolio construction domain, asset allocation domain, and scenario analysis domain. A bit deeper, we talk about ESG and financial risk exposure and limit, and value at risk under domain of risk management. Portfolio weighting and ESG profile versus benchmark under domain of portfolio construction. Strategic asset allocation versus tactical asset allocation will be under domain of asset allocation. And lastly, portfolio scenario analysis will be under domain of scenario analysis itself. Now let's move to the slide 2. Academic versus practitioner research on making ESG-linked performance claim. Both academic research and empirical studies up to period before COVID pandemic had shown encouraging results. Academic survey and meta-analysis were consistently giving higher portion of positive findings and positive correlation. Likewise, a sample study of ESG rating-based performance shows a better off relatively to MSCI in Europe. Let me put a note. MSCI originally is known as a acronym for Morgan Stanley Capital International, but now recently is simply known as General Market Capitalization Weighted Stock Market Index of around more than 1,500 constituents throughout the world. It is commonly used to measure the market cap progress and its dynamic. Now, let's move to next slide. How can business create value through ESG? In this case, we can see that value creation through ESG could be seen from two ways perspective, from the investor perspective and from the company's perspective. From the investor perspective, if they receive positive signal that the company they would like to invest has action to seize ESG opportunities and mitigate risks, then they are gaining confidence and willing to pay higher share price. Note here, the positive signal is based on the ESG rating of the company. Now, from the company's perspective, it should start from the ESG strategy of the company that reflects the company and board vision around ESG. So in this case, we put a note here that consists of these two strategies in action, i.e. net zero strategy, where like developing an emission reduction strategy, which may include net zero target, and reporting strategy, where we need to identify key stakeholder requirement, regulatory framework, and database needed for comprehensive reporting. By having them in place, company will be able to provide the sustainability reporting well and or disclosure of their ESG performance to increase the ESG rating as a positive signal to market. Once the positive signal is received by the investor, they will be more confident about the company's action to embrace ESG and therefore willing to pay a higher share price. We call it as value creation. Now, move to the slide 4, whereby I would like to share with you further about investor perspective of ESG investing. In this case, ESG investing refers to environmental, social, and governance factors that play a role in the investment process. There are 4 common approaches of ESG investing, i.e. the ESG integration, exclusionary investing, inclusionary investing, and impact investing, where the last 3 are also known as sustainable investing. Now, what is ESG integration? It's like a company's carbon emission will be evaluated alongside its fundamental business measure. In this case, investor may say, I want to integrate ESG factors and traditional factors to assess the risk-reward profile of my investment. Now, the second approach, exclusionary investing, like a fund, may screen out companies with revenues generated from fossil fuels. In this case, investors may say, I want to screen out controversial companies or sectors that do not meet my sustainability criteria. Next, inclusionary investing, whereby an investor concerned about global warming could tilt their investment to companies with the lowest material carbon risk. In this case, investor may say, I want to seek out companies that are ranked highly in the sector based on sustainability criteria. And lastly, the approach of impact investing, whereby investing in renewable energy companies with the intent to positively impact the environment. In this case, investor may say, I want to invest in companies that attempt to deliver measurable social and or environmental impact alongside financial return. And on the other side of the coin, it is worth to see the 5 drivers of ESG investment from the global fund management point of view and company's board vision, i.e. 1. Help manage investment risk. 2. My firm derive reputational benefit. 3. Improving financial return. And 4. Client investor demand it as our fiduciary duty. Let me highlight. The survey is in line with the rising growth in responsible investment regulation and policy, and also the studies that showed the rise of ESG investing, or simply ESG investing outperformance. Now, move to the slide number 4 that I would like to highlight ESG investing as phenomena. In this case, investing that takes into account ESG factors in the investment decision will give investors a more holistic view of a company's performance and allowing them to make more sound investment decisions. And next, ESG investing is a form of sustainable investing that considers environmental, social, and governance factors to judge an investment financial return and its overall impact. And then, ESG funds have consistently ranked around at least the middle of their peer group if it is not outperforming. In this case, investors want to ensure that the company they are investing in are engaging in sustainable and ethical business practice. Then, we move to the next slide, where start with the question whether ESG investing generate high return. Well, let's look at this slide. Right after ESG awakening, investors willing to put premium on green factors into their investment decision making. It keeps rising, and we call it the greenium become even higher, bigger, to reflect the gap between brown asset versus green asset. Then now the slide is show us right after ESG awakening, according to certain institute studies, the greenium started to occur as investors put premium on green factors into their investment decision. During this time, there will still some companies hiding by the greenwashing, But since investors were getting more cautious and more scrutinous, it drove the need of ESG rating to be in place. And then, we could see then this slide. As a result, more companies then improve their underlying operation toward ESG criteria performance, not just greenwashing. And ultimately, additional greenium from improved operation made even the greenium even larger in the future. And then the conversion of brown asset into green asset earns significant greenium as seen by steeper tangent. Now, let's see this slide talking about ESG process premium is a risk or all. Having seen how the greenium takes place between brown asset versus green asset in the previous slide, let us have a look into a question whether ESG relate more to the process of making investment based on some typical consideration or more to the premium and risk or risk, or it considers all. In this case, this slide reminds us the investment, whether on its own or within portfolio, refers to the one of the underlying typical consideration. Its value, such as its free cash flow forecast yield, its growth, such as 5-year earning, its quality, such as 3 years average return on earning, its risk, such as a 1-year volatility, its momentum, such as quarterly sales acceleration, size, such as market cap and total asset. And then, what is about ESG? The next slide, we are going to talk not just about premium or forming return of ESG investing. We are going to talk here emphasizing more on the risk reduction point of view as follows. One is ESG risk reduction done right makes for less volatile organization and boosts investor faith. Second, proper ESG risk mitigation makes for less volatile companies and strengthens investor confidence likewise. And third, it is important then to build on existing risk management practices because negative ESG incidents are increasingly damaging and costly. And lastly, in terms of risk, several empirical studies have established that stocks with a high ESG rating have a lower total risk than stocks with the same systematic. Now, let's see the next slide. Does integrating ESG within portfolios reduce risk and generate high return? That's again the question. In these cases, ESG integration is reducing risk through diversification risk, and perhaps in the later stage, it might also reduce the level of systematic risk too. I would say this is a calling for academic researchers and to all of us, or at least a challenge to all of us to elaborate further. Next slide, we are going to talk about ESG integration again, whether generate higher return. We are going to see then, as shown in the previous slide. But now allow me to emphasize further by putting some models that measure both return and risk investment, especially from the portfolio point of view. So far, any model shows positive finding to ESG investing as opposed to non-ESG investing. Now, this slide we are talking that onward about elaboration on the integrating ESG within portfolio, start with some reminder to investor and corporate board about ESG integration is about. Now, we talk about the ESG is aiming portfolio manager with tools and information to identify risk and opportunity with portfolio. Second, enhancing the investment process and implementing this across all our portion. And lastly, making investment decisions that take financially matter ESG information into account. It is not a values-based exercise. It is not just addressing stakeholder concern by approaching external screen based on immaterial issue information. It is not simply developing ESG version of existing products while leaving process unchanged. Now, the next slide, we are talking about the example of ESG funds, which are now quite common to be put into investment portfolio. We can see here some examples, like ESG fund in Europe, in the United States, in Africa, South Africa, and so forth, and etc. And then the next event, I would like to highlight the global asset under management, which are ESG related. And where we go, the global asset under management shown an increased portion of ESG investing and even getting more strong sentiment or confidence that's called bull sentiment. Then the next slide is shown here. ESG even increasing both the amount and the portions of asset under management and even bigger percentage under the bull instrument. Strong confidence, as I have already said. And then if we crop further to the forecast made in 2020 toward 2025 forecast, out of the above, US 150,000 trillion asset will be under management, then more than half are ESG investing mandated asset. Then next slide, the 16th and 17th slide, the next two slides, I would like to show the relevancy of ESG rating at the country level, here, as well as then how then with the credit scoring and so forth, etc. Its relationship with ESG rating and the portfolio sovereign scoring credit. It showed that the higher the risk from the perspective of country ESG risk rating, the lower the credit rating. Note in this case is CRA, or stand for Community Reinvestment Act. In this regard, there are four categories that we use: outstanding, satisfactory, needs to improve, and substantial improvement needed. Then, if we look here again, there are two illustrative examples here how the ESG factors have been incorporated in measuring the portfolio sovereign scoring. It shows that a spider chart on my left hand side measuring portfolio exposure to macro factors including ESG, which is shown in here as 0, means not much thing is observable. And on my right hand side, a spider chart measuring portfolio exposure toward bank worth governance indicator, whereby ESG GPM index are incorporated into consideration. Note here, GPM index score are calculated daily using data from RepRisk, Sustainalytics, and Climate Bonds Initiative as inputs. Now, let me repeat my previous slide to show that ESG process both factors has considered process and premium risk factor. In this case, ESG is about both creating value through premium and risk reduction. Now, we go to the next slide as a pointer. An illustration that certain investment portfolio may change the priority rank due to integrating ESG factors. Say, in the slide, instead of A, B, C, D, E as the rank and priority, it becomes C, A, B, D, E. Where stylish investment chain means the inclusion of beneficiary client, asset owner, and asset manager consideration toward the equity or bonds of the company. Then, let me go to the next slide. The impact of carbon constraint of portfolio, alpha exposure, and optimality. If we talk about integrating ESG within portfolio, it's worthwhile to understand how ESG factors affect the alpha exposure and optimality. One of the ESG factors in this case is carbon constraint. Yeah. Let me refresh a little bit. Alpha is a portion of portfolio returns that cannot be attributed to market return and is thus independent of them. Exposure to alpha is equivalent to exposure to idiosyncratic risk, whereas systematic risk is a risk that comes from investing in any security within the market. Alpha is a way to measure excess return, while beta is used to measure the volatility or risk of an asset. Beta, as we know, might also be referred to as the return we can earn by passively owning the market. But we cannot earn alpha by investing in a benchmark index fund. Back again, the impact of carbon constraint on portfolio alpha exposures is in line with optimality, where the more constraint, the more it overlaps with optimality, especially when the high ratio of book to market. Then, slide 22. Comparing tracking error, ESG rating, and carbon emission. I would like to emphasize here and share with you another ESG factor is carbon emission, which shows the similar result as previous slide. It shows that the lower the carbon emission, the hypothetical CO2 result, the higher than the ESG result shown in their ESG ranking. Now, let me wrap up and close my presentation with the way forward by saying that evaluation of passive approach and the inclusion of ESG within the portfolio, we can see here. The future investment in a single ETF, exchange traded fund or portfolio will be or should be or must be more on the ESG investing. And therefore, let us embrace them more actively. Then, I would like to say then, now, it will not become just temporary phenomena, but it become trend and direction toward our future. ESG-related investing will be bigger, deeper, and stronger because we are going to see more and more regulation on carbon restriction in particular, and more sustainable development goals related enforcement in general. Further, there will be more mandated ESG-related investment in the portfolio. So, I would like to say thank you, spasiba, but let me just vote everyone to keep promoting better ESG performance of organization through ESG investing in our portfolio. As you and me, we live in the same planet. It is not about us for the sake of the investment, but it is about our generation. Again, spasiba.